First year exposes emotional weaknesses they didn't know they had. Year 1 forces a choice. Build discipline or walk away. 1. Expectation versus reality shock. New investors often enter markets with optimism, high expectations, influences from social media success stories. But the first year usually delivers volatility, uncertainty, confusion, flat or negative returns. This gap between expectation and reality creates psychological stress. When returns don't match imagination, doubt begins. 2. The emotional roller coaster. In year 1, investors experience first gain euphoria, first loss shock, first correction panic, first missed opportunity regret. Behavioral research from Daniel Kahneman shows that losses are felt more intensely than gains. That first real loss often determines whether discipline forms or fear takes over. 3. Overconfidence meets reality. Many beginners believe they can time entries perfectly, avoid downturns, spot obvious winners. Behavioral finance research highlights overconfidence as a core bias in early-stage investors. The first year tests this illusion. Market randomness humbles quickly. 4. Myopic monitoring trap. Studies by Shlomo Benartzi and Richard Thaler demonstrate that frequent portfolio checking increases perceived losses. New investors often check daily, react emotionally, adjust constantly. The result? More stress, more trading, lower performance. Year 1 teaches a painful lesson. More attention does not mean more control. 5. Discipline is built in discomfort. Discipline does not appear when markets rise. It forms during sideways periods, drawdowns, boredom, uncertainty. Investors influenced by Warren Buffett often emphasize patience and inactivity as competitive advantages. But patience feels unnatural in the first year. The brain prefers action. Discipline requires resisting that impulse. 6. Identity crisis phase. Year 1 forces a deeper question. Am I a trader chasing excitement? Or a long-term investor building capital? Many quit not because they lost money, but because they discovered investing is slower and less dramatic than expected. The first year strips away fantasy. What remains is either commitment or surrender. 7. The structural advantage of those who stay. Investors who survive year 1 typically reduce trading frequency, lower return expectations, create written rules, automate contributions, accept volatility as normal. They shift from emotional reaction to structured behavior. This shift marks the beginning of maturity. 8. Why many quit. Common reasons: unrealistic return expectations, impatience, fear after first losses, comparison with others, lack of a defined system. Without structure, volatility feels like chaos. With structure, volatility becomes background noise. The core insight: the first year is not about beating the market. It is about beating impulsive behavior. Year 1 asks, can you tolerate uncertainty without constant action? Can you accept slow growth? Can you stay consistent when results are unimpressive? Those who choose discipline enter year 2 stronger. Those who quit often misdiagnose the problem. The market did not defeat them. Emotion did.